Okay, Q&A from Sunday's Market Outlook. Only 3 questions. A lot of the other comments were really just comments, not really questions. This first one deals with MicroStrategy. How would you short this stock while avoiding getting stuck on the wrong side of momentum? And there's a really simple answer to that one. Do not short this. At no point in the 3 videos I have put up about MicroStrategy did I ever say short it. I've just pointed out that it is I think a questionable stock by a questionable CEO. But I'm going to, on Sunday's Market Outlook, I said that I would put out a video later this week talking a little bit more about it. I'm not going to do that. I'm going to move my discussion of it to the applied level. For the module for portfolio construction and management, I'll be adding to it this Friday for Bitcoin and MSTR. I'm trying out something, an experimental position, because I think I figured out how to play this thing and what is really going on here. So I'm testing a theory, and I'm benchmarking to a put for both MicroStrategy and IBIT, which is a Bitcoin ETF, in a 10-to-1 ratio, 10 here versus 1 here. When you benchmark to a put, it basically, the put itself tells you when to add and when to subtract to your position. And it gives you, if you play it right, you can usually get a lower average cost than what the put would give you if you just used puts. So I'll explain how I'm doing that and what my theory is behind this. And I will tell you it is surprising. Let's look at your question here. How would you short the stock while avoiding getting stuck on the wrong side of momentum? Well, you will get stuck on the wrong side of momentum. Do not short this stock. Just today, Trump's new SEC chair, he announced Paul Atkins, who is a pro-crypto person. So I just wouldn't short this space at all. Would you do a long put here? Probably not. There's no money in the puts simply because of their slope. Short butterfly condor, complicated strategies usually never work out very well. High volatility makes the option premiums really expensive though. So what is, let me erase the top here and I'll just show you sort of the structure. Given what we have right now is negative skew. And just to give you a quick refresher here, if we think that this is the price and these are strikes above the price and strikes below the price, if we think in terms of puts and calls, skew is you take the price and you take 90% of the price and you find a put, and you take 110% of the price and you find a call, and you look at the implied volatility on this, and the implied volatility of the put minus the implied volatility of the call will give you a measure of skew. We have skew right now that looks like this. You have basically negative skew. When you have something like this, if you had skew that was flat, that is saying that every option has the same implied volatility. Just to give you an idea of what the distribution of the puts and calls would look like, let's say that this is the price, a put and a call. If you had, let's just make it really simple, and we have an interest rate of 0. A put and a call would have the same price at the money, that have a delta of 0.5 with an interest rate of 0. Let's assume no dividends being paid right now. And as you went, let's say $5 down and $5 up, and you looked at prices, they would have the same price as well. That you'd get something that looks like this in terms of the prices for calls and puts at the same distance from where the stock price is. Again, that's assuming that all strikes have the same IV and you have an interest rate of 0. If you have skew that looks like this, where the put, the implied volatility on the puts is super elevated, you get something like this. You get a distribution that would look like this, where the call would look like this. All right, so that put spreads become really cheap because you could buy this put and sell this put, and it's really cheap. But call spreads are expensive because if you bought this call and sold this call, you're paying a lot of money to get that done. And that's if you had elevated implied volatility on the puts and you had increased skew. Well, what if you have something like this? You get something that looks like this on the calls, and you get something like this that look on the puts. So if you bought a put spreads are expensive, but call spreads are cheap, right? So buying a put spread gives you limited risk, because you can only lose as much as the spread has. So if you bought the higher you can only lose as much as you paid. So if you bought the higher strike and sold the lower strike, whatever you paid, that's the maximum that you could lose. So I would say that if you really want to short this, I guess let me start by saying this. If you have no particular reason to short this or buy this, then don't. Just go somewhere else, because this is not something that economics and finance can help you solve. If you want to understand this whole space, everything you learned in finance and economics, throw it out the window. For those of you who have a background in social psychology, you guys know how to play this. In my PhD, my minor was sociological theory. And I did have the option after the first course to take a seminar in social psychology, and I thought, well, why would I want to do that? And I really wish I did. I would have figured this out a lot sooner. If you have no reason to be here, don't. Just go somewhere else. There are easier fights to win that are in your wheelhouse that are amenable to what you've learned in economics and finance. This is not. There is I shouldn't say no fundamental value to crypto. There is minimal fundamental value to crypto. So you end up thinking that, well, these tokens are mostly worthless. And I'd say 90% of the tokens out there are mostly worthless. That Bitcoin might have some value for some of the few things that are happening on it, but certainly not $100,000. But that's not the point. This is not economically or financially driven. It's social psychologically driven. You can't short social psychology. Don't even try. If you really want to, though, benchmark it to a call. So find a call, find the delta, and benchmark to that delta, because you'd be playing the same game as the gamma traders, which is the game that's going on. So you may as well play the same game without the call. You can benchmark it to a call. So go to an $800, let's say $800 strike price. Still got a high delta. You'd be amazed at what the delta is on this thing. And short the number of shares that's in the delta. And do not change your position until the delta changes. And keep sizing your position to the delta. That doesn't mean you're going to make money, but at least it gives you an in and an out. Or use put spreads, but put spreads aren't very attractive. So if you go to June 2025, first of all, spreads are wide. They're like $6 spreads on this, but I think if you put a price in the middle of the spread, you could probably get it, because I do see some volume on these. A 370 put will cost you $178. I'm not kidding you. $178. You think, why not sell the put? If it's put to me, I'll own it at $192. It's got, 100. If you think about the price of Bitcoin and where it is now, its net asset value is somewhere probably around $150, $140, $150 a share, considering the Bitcoin it has. Actually, I take that back. If it did fall to that price, the convertibles would not convert. That debt would have to be paid. The Bitcoin would have to be sold to pay it. So you'd have to deduct the debt off the net asset value. It probably has a net asset value of about 110 at that point. But 178.15, The 300 put is 126.40. So it'll cost you $43.75 to get a $70 spread. That is not great at all. $43.75 to get a $70 spread. But look at this. There's no premium in the call spreads, so they're great to buy. Buy a $600 call is $161.10. Sell a $700 call is $148. You get a $100 spread for $12.70 because you have this kind of skew going on the calls. So you're risking $1,270 and it might return $10,000. Here you're risking $4,375 and it might return $7,000. This thing is just not set up to short, given the structure of the skew. And from a social psychological perspective, it is getting, I think, riskier and riskier to short. Now, let me sort of give you a story, and then you can sort of relate it to crypto, and this is really the issue you'd be facing. What if I told you that I've designed this trap? And it is a kind of like a small house with a door, and it's a one-way door, and the back wall back here is all eucalyptus leaves. And you can go in, but you can't get out, and it's reinforced, so a gorilla is not going to tear those walls down. This is to hunt Bigfoot. You should license this design from me and build these things and sell them, because believe it or not, Sasquatch, they love eucalyptus. They just, you don't find it very much in North America, but they love eucalyptus. You should license this from me. Now you might think, well, that's absolutely ridiculous. But what if I told you, I sound like one of those late night shamans, eh? But wait, what if I told you, I'll throw in a set of steak knives. What if I told you there was this city over here, a population of 2 million, and it's surrounded by mountains, and these people over here have absolute certainty that Bigfoot exists, that Sasquatches exist. Is that enough of an opportunity? Must you believe it? These people have absolute certainty, right? Who cares? At that point, you would say, well, what a great opportunity to sell to these people. But in you selling to these people, you'd be thinking, this is the stupidest thing I've ever seen. This is ridiculous, Bigfoot. But these people have absolute certainty, right? If you understand that, you understand crypto, and you understand the people that are involved in crypto. Okay, our next question. On the topic of alternative forms of cash investments, are there any other safe, liquid uses of excess cash that companies can utilize outside of T-bill money market funds to earn an excess return? Or would that be too good to be true? Well, I think you have to first ask, is this something you want the company doing? Do you want them risking cash on, let's say, an investment in assets that is not their core business? This was a big debate years ago when I was doing my MBA. This was a big debate about whether or not companies should make donations to charities. On the one hand, it is being a good corporate citizen. On the other hand, a company is making a decision for all the shareholders that this is the charity everyone will support. So the argument was that if companies want to make a donation, they should return that money to shareholders and allow the shareholders to determine which charities they want to contribute to. If a company wants to invest in risky assets outside of operational assets, wants to invest in risky investments and risky securities, the argument would be from those same people that Don't go buying Bitcoin, because if I am long Johnson and Johnson, and Johnson decides we're going to start buying Bitcoin, I would then say, but I've got exposure to Bitcoin in other parts of my portfolio. You are now overexposing me to the asset. Return money to shareholders and let shareholders decide if they want to get exposure to it. Because Bitcoin is not, or any crypto, is not an asset that is germane to the operation of the business. So let's, with that question out of the way, that, should we even want companies to adopt crypto assets in their treasury model? I think I side with the no. That if there is a motivation to put money into crypto and it's not germane to your business model, in other words, I didn't buy your company because that's what you're doing, you just decide to, my argument would be return money to shareholders. You clearly got excess money, return it to shareholders, and then I'll decide whether I want access to it or not. So let's answer your question in terms of, are there any other safe liquid uses of excess cash? Let's define what excess cash is. It is your cash minus your working capital needs. This is true cash. This will be held in just bank accounts. The rest are held in cash equivalents, which could be T-bills, but you can reach for some kind of credit spread, commercial paper or banker's acceptance. These are all rated AA, even AAA sometimes. Or you can go for a little bit longer term and get some duration, very low duration and very low credit risk. So if you have, let's say, low money market rates out to the 1 year, usually we have upward sloping yield curves. If you have very accommodative rates, you'll have an upward sloping curve that kind of looks like this, that rather than taking the 3-month rate, you can go out and say, well, we can take a 3 or 4 year yield, get a higher yield, because there would be a spread between the two, and they'd be listed as marketable securities. Available for sale, AFS, available for sale and marketable securities. You have low duration even in a 2-year and very low credit risk if you're buying investment grade 2-year or 3-year paper. So you can still park money somewhere that has low volatility and is safe, because this is shareholder money. So companies with a dividend or share buyback program cannot accept price risk with shareholder funds. For example, we take companies like GM or Costco. They've got a lot of money on their balance sheet. But both those companies engage in share buybacks, and both of those companies return money to shareholders through dividends. So in the meantime, they're just hanging on to that money. You don't want them taking risk. So just because you see a company with excess cash that's not in Bitcoin, you can't criticize them, because, well, what if I got to pay a dividend and Bitcoin goes from 95,000 down to 75,000? It's like, I gambled with shareholder money. You do not want that. If Costco decides we're going to hold Bitcoin, it's because they start accepting Bitcoin. Then I would say, well, then you need some working capital. But if they say we're going to adopt Bitcoin as part of our treasury model, I would say, hold on a second there. If that's what you want to do, you clearly have excess cash. Return it to shareholders and allow the shareholders to determine whether or not they want exposure to that commodity. Crypto is a speculative, non-operating asset for every company that is not involved in the crypto space. So to critique companies and to say that they're not adding shareholder value or destroying shareholder value by not holding Bitcoin is sort of a stretch, I think. If a company wants to hold Bitcoin, if it's germane to their business, then okay. But if they're just holding it to say, hey, yeah, we buy into this, then return it to shareholders. Much like if a company wants to make donations to Planned Parenthood. Let's say you're an investor in Costco and they say, well, we're going to make donations to Planned Parenthood. Wouldn't you say, hold on a second, you can't make that decision for me. You're making it for the shareholders. We own this company. If you want to make donations, give the money to shareholders. Let shareholders make donations. If you want to hold risky assets, give that money to shareholders. Let shareholders determine if they want to hold risky assets. Okay, this is a long question, but I think it's a good question to dive into, because there is, I think, some confusion When we talk about government spending, we think that governments are the ones spending the money. The majority of the government budget is not spent, it's transferred. It's transferred to corporations or it's transferred to private individuals, sort of a redistribution. Thinking that IWM and the small caps not performing going forward, since they had their chance to perform and aren't proving it, I think is misguided. This comes from a statement I made because I am short IWM. I just don't think that the environment that we're going into is going to be as friendly to small caps as the market is thinking right now. I still think we are in an era of large firm capitalism, and I had made this assessment several years ago. Some of you who may listen to me from week to week for the market outlook may remember that I did say I believe we are entering into an era of large firm capitalism. And S&P has performed incredibly over the last 2 years, where small caps have been right? If the environment was so tough, everyone would have a hard time. But I think that the environment and where we are today is almost set up for large cap companies to succeed. So let's that's the sort of opening sentence is based on my assessment that if I'm going to be short beta, I want to be short on the small caps, not the large caps. You're assuming that with real GDP being 3% is a good environment for them to do it over the last couple of years. One, it's arguable that we've been in a recession. And two, GDP calculates government spending as a positive, which is wrong. Government spending steals resources from the private sector. So when government spending is inflated like it is now, it makes GDP seem better than it really is. That is wrong. I will demonstrate that the government spending is not inflated. Government transfers are inflated, but government spending is not. And it is not contributing any more to GDP than it has in the past. In fact, it's contributing slightly less to GDP now. I think you should factor out government spending when determining GDP. And that would be a problem. Murray Rothbard argues this. So with that, it makes sense as to why small caps didn't perform over the last few years and potentially have a chance to grow now with free markets hopefully returning. Well, then how do large caps do it? Wouldn't every company have suffered that? If we look at the S&P 600, these are profitable small caps, whereas the Russell 2000 has a high proportion of unprofitable small caps. Why just them? The small caps have been profitable and performing. The mid caps have been performing. Large caps have been killing it. NASDAQ's been killing it. Well, if this is such a tough environment and it's going to get better, why did they suffer? Anyways, let's have a look. Let's break this down. Saying government spending is inflated. Government spending is not inflated. Government transfers are massively inflated. Let's look at government spending in GDP. And these are nominal numbers. This is annualized. This is 2024, third quarter annualized GDP running at almost 30 trillion. Government spending in GDP, 5 trillion. The feds are 1.9 trillion. The feds. State and local are 3.14 trillion. So if we're thinking about the feds, when we think about the budget deficit, that is at the federal level. There are a whole bunch of deficits further down in government spending as well. So if we look at government spending, federal, state, and local, it is 17.14% of GDP, normally runs about 20%. So it is rather light right now. And it breaks down into consumption and investment. Consumption, 39.46. That's 3.9 trillion in consumption, with 2.5 trillion coming from state and local. And investment is $1 trillion, almost 1.1 trillion, 614 billion coming from state and local. But the federal budget is about 6.8 trillion for 2024. 6.8 trillion. It spends 1.9 in GDP. 1.9 of that 6.8 is counted in GDP. Where is the rest of it going? Transfer payments. Social Security, welfare, subsidies for businesses, grants, the CHIPS Act, you get money and you get money, subsidies for business. Take away all those EV subsidies, Tesla would not have been as profitable as it would have been because many of those vehicles would not have been purchased. Middle income people buying Teslas, household incomes of $150,000 to $200,000, getting $7,500 credits from the taxpayer. That is included in C. When the individual buys the vehicle, because the government money, the subsidy, goes to help purchase that vehicle, that is counted in consumption, which is not counted in government. So it is a transfer. The individual made the choice to buy the EV. So how can we not count that, right? Subsidies for businesses, again, this is not included in GDP since the government does not receive a good or service for the spending. To be included as government spending in GDP, the government must receive some service or some good. Now, to remove that from GDP, all of this spending is done in the public space. So if you have to pave a road, that would be state and local. That government is not involved in the production of asphalt. It has to buy that asphalt from a business. It is not involved in actually paving the road. Usually it contracts that out to a firm that paves the road. So around here where I live, you see there are a couple of big construction firms that do a lot of work like that. So whenever you're driving down the highway here, it's always under construction in the summer because of course it is. You see the same companies year after year doing the work. These are private companies that are receiving money from the government. That is government spending. They're receiving a road, but private companies get that money. These are not large multinational corporations. Google and Microsoft are not paving these roads. They are usually local companies that are doing it. Significant companies, but local companies that are doing it. So let's just think about that. 6.8 trillion at the federal level and only 1.9 shows up in GDP. You can see the sheer amount that gets transferred to the private sector, whether it be the consumer or whether it be the business. With that kind of handout, with that kind of largesse going on by the government, if small caps haven't been able to make it during that period of time, if there's going to be, with Doge, some significant cutbacks in spending, how are they going to do it? How are they going to do it in a much more challenging environment when there's less handouts going on? So when you have this kind of giveaway, this is the big part of it, is this giveaway over here. And all of this over here, this is the big part of it, along with the interest payment that has to be done. That's not counted in GDP. That income belongs to the people receiving it. And then they spend it, and that contributes to GDP on their own. So much of this budget, the decisions of how to spend it, are made by consumers and private individuals. So to say that it's stealing resources from the private sector, it's redistributing resources from the private sector. It's taking money from some people and giving it to other people. The idea that the government, if they stop spending, would free up resources for others to use, assumes a capacity utilization that is very high. So, for example, there is a nice little REIT that I own in Canada. One of its tenants is the government of Quebec that rents one of their top 10 tenants. Government of Quebec. Now, if they decided, okay, you know what, we don't want these spaces anymore. Well, there's lots of vacancies. If there were no vacancies in any of these office properties anywhere, then them leaving would open up an opportunity for someone to move in, but there are lots of vacancies. So if they moved out, chances are you just have an empty unit for a period of time, and the owners of this particular REIT, this particular property, would not be receiving that rent, and the shareholders of that REIT would not be receiving that rent. which means they would not be receiving a dividend of which they can then spend as they wish. Only if they were, let's say, using an office building in an area of town that was growing massively, and they were just sitting on this office property, and you could see so much potential if they just sold that building and moved out. There you could say, okay, they could free up that resource to be used somewhere else. But just because a dollar is saved somewhere in government doesn't mean somewhere else it's being put to better use. There may be no use for it. This idea of freeing up resources, that is at a macro level over a period of time. It's not a zero-sum game where, they're using this dollar, which means that I can't. I got to wait for them to stop using it until I can use it. It just doesn't really work that way. So if you cut back on government spending, you make this in particular more challenging. As far as the government spending goes, a large part of it is on defense. Now you can cut back on defense, but you also cut back on defense contractors, which is a private company staffed by private individuals who get paychecks, who go to the mall and spend it, and it shows up in the C component of GDP. It would be difficult to separate those. It would be difficult to take it out. There is a misconception that the budget is government spending, that the budget equals government spending, and this is what is measured in the G component of GDP, because we have C plus I plus G plus the trade balance, X minus M. There is G right there. From the feds, it is 1.9 trillion of the 6.8 trillion that they spend. The rest of it is either in C or in I, because it is a transfer of resources. Well, the consumer gets to decide how they want to spend it. Now, if you give a tax cut, you're going to leave more money with C and I, and maybe you have to reduce subsidies for business. Maybe you reduce some grants. Maybe you cut back on some spending here. But you have to have some theory that if I take money from person A and give it to person B, that somehow that's less efficient if I leave money with person A. Usually these transfers, especially these over here, go to lower income individuals who have a much higher propensity to consume and there's a higher velocity of money there. So if you give $100 to a low income person versus giving $100 to me, the low income person is more likely to contribute to GDP at a faster rate than I would, because I wouldn't spend it because I have excess funds. So I most likely wouldn't spend that $100. So taking $100 from me and giving it to someone else is almost like forced spending. It's like, well, if you're not going to spend it, we're going to take it from you, redistribute it, and give it to someone else. Yeah, I don't think that's fair. I don't like taxation for redistribution, but a lot of it, that's what that is. I know this is a really long answer to your question, but when we think about government spending propping up GDP, the spending itself, not really. It's the transfers. It's the transfers that are contributing to growth. This is what you have to look at. When we look at the deficit, it's 1.8 trillion. That's 6.1% of GDP. If we think about the deficit versus GDP growth over the last 6 years, you can argue that government transfers have been responsible for almost 100% of GDP growth in the last year. That if you ran a balanced budget and you just got rid of the deficit, for 6 years you would have had a zero growth economy. So yeah, it's been in a recession. Now you're going to cut back now you're going to cut that back, when the underlying economy has really been growing at 0% for 6 years. Without those deficits, I don't see how small caps make it. If they haven't made it with all of that transfer, with all that free money going on, if they haven't made it, what makes you think they're going to make it going forward? That's my position, is that I want to be short beta somewhere. I just don't think that it's wise to continue to be short beta on the large caps, it makes a lot more sense, I think, to be short beta on IWM.